Hannover RE believes it can still meet its full-year guidance despite a, quote, major loss expenditure. The group also said it expects significant price rises across all areas in January renewals. Clemens Jungssthofel joins us, the CFO of Hannover RE. Clemens, nice to have you with us. Can we just talk through maybe that exceptional in the earnings and just tell us a little bit about why it's there, what it signifies?
Yes, good morning and thank you for having me. Yes, happy to shed some light on the 9 month numbers. I mean, you will have seen, of course, the top line. To start off with, we have seen strong diversified growth both in our property and casualty business as well as in life and health insurance. As for the property and casualty business, you will have noticed our large loss burden, so losses that we quantify as in excess of 10 million euros gross. The large loss burden has been 1.5 billion for the first 9 months, which is already 400 million in excess of our budget for the year. Counting a couple of losses, for example, the European storms early in the year, but then the Australian floods, and then, of course, the Hurricane Ian, adding 276 million to that list. We've also seen some run-off losses due to inflation, etc. So therefore, there was a huge loss activity in the P&C segment. On the other hand, we have seen decreasing claims on the life and health business stemming from COVID. 228 million. That's an expected decrease, but still that burden is still in the life and health numbers. However, profitability in life and health, underlying profitability being very strong, and life and health has added 441 million of EBIT to our earnings. And then we have our strong investment income. Particularly our inflation-linked bonds have added roughly 300 million of EBIT to the bottom line. And that's the reason actually why we believe that we can still achieve our guidance for 2022.
And can we talk a little bit about the reception of higher premium rates at this point? Are you finding any resistance to increases, or are existing customers and potentially new customers willing to pay the additional premiums, or are they shopping around and leaving you?
Yeah, I think if we look at the market environment, really, I mean, when we look at the last 5-6 years, I mean, you know, we've seen large loss burdens over the last couple of years, insurers, reinsurance not earning their cost of capital, etc. So the market environment was driven by price increases due to that. Then we've seen the pandemic, we've seen the war in Ukraine, and now have inflation on top. And as for loss activity, as explained earlier on the P&C side, you see 2022 is another year of losses exceeding budgets. So therefore, I think pressure is on. And you've seen some reactions in the market where market participants actually withdraw capital. So now I think the environment has fundamentally changed now. I think we are really looking at a really hard market going forward. And our main renewal, 1st of January, will be driven by substantial price increases, even on a risk-adjusted basis. And when I say risk-adjusted, I mean really considering also inflation. So on top of nominal price increases due to inflation, we need to make sure that prices are adequate and are reflecting the environment. So therefore, yes, there might be resistance here and there, but on the same side, I think our clients recognize the fact that we have increased loss burdens, and therefore I think there is preparedness. That was the sound also on recent meetings in Monte Carlo and in Baden-Baden.